All right, roundtable. Well, we finished off yesterday's session, yesterday's coaching session with three or four different trading plans on the British pound. And what we were looking at was this really fast move in the pound, followed by this consolidation. We looked at the daily, we looked at the hourly, and found that up in this area was basically a resistance zone. And one of the questions that came up was, hey Mac, how does resistance get formed? So we spent a long time talking about the literal way that this stuff up here gets formed, but then we translated that into a trading plan. So of course we're looking at the effect. We had three options for the trade. The first one was the aggressive entry. What that means is you figure out where your stop needs to go above a prior high. You count down. Actually, let me elongate this. So let's say, for example, it's this level here. You figure out, all right, my stop needs to be that big, so my entry is going to go here. The reason why that's an aggressive entry is because you're anticipating the market. What you've got to get through your head as best as you can, and I'm saying that to myself as well, because so many times it falls out of my head, is this idea that it's not our squiggly lines that creates price. And so often I'll draw a line on price, or I've got I've got something on my chart, and I'm convinced that that line on my chart makes price do something. I've got to get it through my head that isn't the way the market operates. So by placing an order in the market here, I'm anticipating price. What I'm literally saying is that I believe there are enough sellers in this price region so that price will go down from there. Because remember, what makes price go down is either or both a lack of buyers or a lot of sellers. You could have one of each or both. That's just how the market has to work, even in an electronic market, as long as it's liquid and it's actively traded. So remember, aggressive trading simply means you're going to get stopped out more often, which means you need to take a smaller stop. The second trade came in right at the London Open. This bar here is, and I use the word London Open loosely. There really is no quote open. There's not somebody ringing a bell. People trade the Forex market 24 hours a day, 6 days a week. Well, almost 6 days. Anyway, whatever. So right here at the beginning of trading, early morning hours in London. Why do we focus on the early morning hours? Because that's when traders are getting the book from the Asian session, corporate clients are in, bankers are in. There's simply put a large number of traders. So right here at the open, 3-bar reversal gets triggered. The next entry that we talked about was trading off one of the prior lows. That came, I would say about midway through the London day. If I look at the time here, that's 5 a.m. Eastern is when you had a good opportunity. I would say a more pronounced opportunity came around 7 a.m. Eastern. Either one of those trades would have worked and would have given you a low risk entry. In fact, the 7 a.m. was even more low risk because your stop goes above that high instead of that high. The last trade, which was the retest, really didn't come until way too late in the session. It's right here. There just was not enough time for a day trade to work. Plus, let me just leave it at that. There just wasn't enough time. So anyway, case in point, jump in on the coaching sessions. We go through a lot of theory. We talk about a lot of methodology. But as a result of that methodology, it's like practical stuff like this. We had 3 entries. It just so happened, a good number of traders in the roundtable sessions could have gotten in on this. I haven't yet surveyed them to find out who did. But 2 and 3 of our entries got filled just based on a very simple plan that's backed up by how the market actually works, not some kind of wishful thinking or just math that we put on our chart.